Ali, starting with the macroeconomic picture, rising interest rates has clearly been a headwind for technology stocks. Now attention's turned to when the Fed might cut and at what pace. What's your and the team's base case?
We continue to expect moderate US growth next year, and that inflation will continue to trend down to target, and that will ultimately allow the Fed to cut. I think coming into the year, the market got a bit over its skis about when that might happen, looking for kind of 6 rate cuts or 6 25 basis point rate cuts starting in March. Since then, we've had a hot Q4 GDP print in the US, coming in at 3.3% rather than 2%, which was expected. We've had pushback from the Fed themselves about when that might happen, including Powell saying he doesn't think a March cut is appropriate. And we've also had a hot or slightly hotter CPI and PPI print, which again just gives the Fed a little bit of pause. So the market's now, I think, at between 3 and 4 cuts this year, starting about June, which feels fairly reasonable to us. I think the key point from our perspective is that an environment where rates are coming down at whatever pace, inflation is moderating, but growth is low but positive, that's a pretty good environment for tech historically because of the scarcity that growth tech offers.
Okay, now technology has had a strong 2023 and a strong start to 2024, but it has been driven still by the mega cap stocks. When do you expect that to broaden out to other technology stocks?
The mega cap question is an important one, and I think it's worth noting that the mega caps had a great 23, but they had a disastrous 22. And if you take the 2 years together, the Magnificent Seven, as they're now known, are only about 15 points ahead of the S&P. And that just reflects a terrible 22 and a really strong 23. They have also delivered really strong earnings upgrades and cash flow estimates. And that is a reflection of strong execution, a bit of religion on cost cutting, and the fact that they are becoming increasingly well positioned for AI. And we think that's a really important part of that story. In terms of breadth, we as fund managers tend to be structurally underweight the mega caps because they are just so large in our benchmark, much as we've liked many of the stocks individually. We saw that something of an improvement in breadth towards the end of last year, as yields came back down to about 3.8% by the end of the year, actually where they started 2023, funnily enough. That has reversed slightly this year. We've had yields go back up to kind of 4.2 or 4.25 on the 10-year, which creates a bit of a headwind for small and mid-cap. We have been changing the portfolio somewhat in favour of small and mid-caps, where we find more exciting risk-reward, frankly. A lot of that is in the new AI computing stack out in Taiwan and Japan and other areas. And we've been using some of the mega caps, particularly Google, particularly Apple, as a source of funds for that trade.
Now, it's presumably been a challenge managing that concentration risk. You're seeing these large companies just get bigger and bigger. You know, how do you keep up with those, but at the same time manage the risk of not having too much exposure?
We've been quite careful about it, and the fact is that these mega companies are extraordinary assets. Many of them are natural monopolies. They look incredibly well positioned for AI. They've delivered these earnings and cash flow upgrades. So the danger has always been to be too bearish on these companies just because they've had a good run or they've had some good estimate revisions. The way we think about it further down market is, where are companies positioned for AI? So we go through every company we look at with an AI lens, as we call it, to try and work out where they're positioned for this new extraordinary technology in the form of generative AI.
Well, picking up on AI, how do you distinguish between companies where AI will have a material impact on the share price and those where it might have a lesser or negligible impact?
We have a very large team of 10 people who spend all of their time basically doing that. And we are very fortunate to have had a lot of experience in this. So we launched a dedicated AI fund 6 years ago, run by Zhu Zhao, which has existed essentially to answer that question. So we've been looking at this and thinking about this for a long time. We've been pleasantly surprised, I think, by the pace of AI adoption and the pace at which things have become real. Because in tech you get these hype cycles where everyone gets excited about new technology, but in practice it takes a little bit longer than everyone thinks to come through to revenue, to come through to something you can actually invest against. That hasn't actually been the case with AI. We've seen very quick adoption. We've seen revenues turn up, NVIDIA most famously, but also all through the new AI computing stack supply chain. And we've seen a number of data points that give us a lot of confidence that we're at the beginning of a really exciting trend in AI.
Okay, well, having had such a strong run, the Nasdaq's now nearly at all-time highs again. At what stage do you worry about exuberance?
I think there are people making the case, obviously, that tech looks pretty fully valued at 1.45 times the S&P. And I see the argument that if you go post the 2008 crisis, tech is normally traded between 1.1 and 1.4 times. And we've now clearly broken out of that range. To us, that reflects the fact we are in a new paradigm. There will obviously be bumps on the road to adoption, and there will be setbacks, and the path is never clear and never easy. But we think that the early data points around AI have been very encouraging. And a few examples of that, perhaps the most important, is the fact that in Q4, all of the hyperscale players raised their CapEx expectations this year. And that was not expected. And they all did it for the same reason. They see massive opportunities in AI, and they want to invest aggressively to win there. And we take note when the people with the most data, and in many cases the smartest people in the room, are all doing the same thing for the same reason. And we think that's a really important data point. Secondly, some of the early AI applications have been adopted quicker than any other in history. We've seen ServiceNow talk about that, we've seen Microsoft talk about that, we've seen Adobe talk about that. Again, these things were questionable about how quickly people would adopt them, whether they pay for them, and it seems, at least from the early data, that they are paying for them and they are adopting them quicker than anything they have before. So that's quite exciting. Third, we've seen the IT services companies, where we don't invest, but we certainly listen to what they say, talking about generative AI showing up in every client conversation, every client project. And finally, we've seen Microsoft's Azure cloud get 6 points of growth from generative AI versus 3 last quarter and 1 the quarter before. Absolutely exponential growth. And that's been really, really interesting to see. And again, speaks to a technology that has arrived and is sort of getting ready for prime time.
Okay, so given all of that context, how has the trust performed over the past year?
We've performed pretty well. We've been pleased with performance, both versus the bench and versus peers. And that really reflects the pivot we made in the portfolio last year to AI. AI has been where investors have wanted to be, and we made that pivot last year. The other thing that we benefited from is to make that pivot, we also sort of reduced or actually got out of some areas that have been a bit weaker, like electric vehicles, like clean tech, like China. It's not that we don't like those kind of trends longer term, it just feels like AI risk reward at this stage, at the beginning of the adoption cycle, is just more interesting. So that's helped too.